to show y'all, except for crowdfunding sucks. I haven't figured it out yet. I'm trying to crack the code on that. And I haven't done an ICO, but I'm thinking about it. We'll see. So except for those, I've done every single thing on here and more. So let's get started. So what I'm going to do, so I don't know where everyone's experience is. So how many of you have you would say have a really robust finance background? Okay, how many of you have seen a P&L before? Okay, how many of you have raised money before? How many of you raised venture? Okay, how many of you have done like debt, like you've raised loans and debt and stuff? Okay, good. All right, so some of this you will know and some of this you won't. I thought I'm going to fly through this basic stuff and try to give you guys 15-20 minutes towards later, and we'll talk about issues, problems, questions y'all have, and try to brainstorm and figure out what to do to help you. What this is not is me standing here saying, hey, I've got 20 rich guys who want to all give you money. That's not what this is. This is just like, I'm going to show you some stuff, and we'll talk about it after. Okay, so two types, debt and equity. And you guys roughly know the difference. Obviously, debt, someone is giving you money, you're paying them interest, they don't own anything. They may have warrants, we'll talk about those. Have you ever done warrants? Who's done warrants? Okay. Equity, obviously they have an investment in your company, and there's all types of terms and conditions that could apply. Pros and cons, pretty simple, right? Debt, non-dilutive, non-controlling, great returns for your investors. You can lever the company up if you need to. You got to pay it back. That kind of sucks. It may require personal guarantee, PGs. That's not great. Secure of all the assets of the company. The pros and cons of equity, you don't have to pay it back. Let's be real. They're betting on you, you're betting on them, and that's a great benefit. You gain mentorship, which is what you guys are doing here, which is great. You can get some great advisors and great investors on your board. And market validation, there's nothing better than saying, hey, I'm a Sequoia-backed company. People go, oh, you must be great. We're like, yeah, I'm so great. It's a validation. It's a great thing. And the higher up on the realm they are, the more validation you get. Not secured any assets, so they're at the bottom of the stack. It's dilutive. It's hard as hell to get. It limits your controls and rights, right? Okay, so you guys know all these types of things, but I think it's always important because some people haven't dealt with certain types of groups before. So I wanted to just kind of talk about those for a minute. So angels and family offices, there's lots of them, millions and millions of them, right? And you're always trying to find 1, 2, 10 of them. And they do debt and equity both. And they're going to go on their gut instinct, and they're going to go on the person, and they're going to go on their communication and how they fit with you. And that's how you're going to sell them, right? That's your strategy, is do they see my vision and they want returns too, but if they see your vision, you can get a spark in their eye, then you've got them. That's your goal with those guys. And whether you structure it, there's tax advantages to both. There's strategic valuation advantages to both. And it just depends on the situation, and get some good people to help you when you're doing that so that you make good decisions on what type of stuff to do with angels and family offices. They usually won't lead around. You almost always have to, you'll get further with them if you come to them with terms. They don't like to lead typically, unless it's a really big, like I know Holt Ventures will lead. Well, there's some big family offices, the HEB family. There's some offices that will lead, but for the most part they don't. So on the debt side, commercial banks, we all know who those are. B of A, Wells Fargo, Square One, local banks, SVB, all those guys have different strengths. And even though you're a startup, sometimes those guys will do something for you. And if you get money, if you get a little tiny bit of this, sometimes they'll give you a little bitty tiny bit of that, which is nice, right? And we'll talk about the different types of loans. But commercial banks, their favorite thing to do is to wait till you have just this much traction and then come in behind someone who has a little bit of cash and get all of your operating bank accounts, right? So if you've got international transactions or you have currency things or things that get them excited, they'll move the needle for you a little bit. They'll be more, like I've got a company, if they're pretty early stage and they're a gaming company, but they do a lot of international back-end transactions, and so that banks love them because they're making fees on all these transactions, and so they've got a loan that they shouldn't have. But they have it because, I shouldn't say shouldn't have, they deserve it. But no one else would probably give it to them if they have all these other things that are really positive. So you've got to kind of play the angles with those guys. Finance companies, don't rule them out, okay? Never rule finance companies out because they're real aggressive and they're not regulated like the commercial banks. Commercial banks flat out can't do things. They're like, we just can't do that. And they're like highly regulated. These guys ain't got no regulations. They're like, I mean, they probably do some, but not many. But like Fidelity Finance, G Capital, Dell, anytime. So what I would do is, even though you're an early stage startup and I'm a software company or I'm a this kind of company, I'm all intellectual property, you know, if you've got 10 computers you need to go get, freaking go to G Capital or Dell or Fidelity Finance will give you like 50 grand like with a signature. Like, just be smart, and they'll just take an interest in like assets they're supporting, or if you have any sort of other interesting things. So take advantage of those to help lever your company up when it makes sense, to kind of give you more capital runway. And those deals can get big, obviously, but for the most part, they'll be small until you've got big revenue. And they're expensive, but they're easier to get. Levered banks. So these guys are very close to equity. And so typically what they will do, so Ares, Hercules, Midcap, Oryx, Point, okay, so I'll give you examples. There's like millions of all of these, obviously, but like these are some examples. You can kind of look these sites up and say, what do they do? How do they work? Because you learn about them. So levered banks, what they do is they come in, and almost always, so if you go in, if you've got a little revenue, if you have to have something started, not always, but usually, and if you have someone willing to come in, and it's almost always a venture company they want in front. So they almost always want venture something, blah, blah. So-and-so ventures, whatever. And they come in, and the venture guys give you $1 million or $2 million or whatever you're able to get, or 10 million, whatever, $1 million, 10 million, $1 million, whatever. Those guys will come in behind, and they'll give you debt. They'll just strike a pen and give you debt behind those equity guys. And the reason, I'll show you, the terms are ugly as hell, and I'll tell you how they work. But the way they work is they're depending. So, for example, if you've got S3 comes in and gives you $2 million, well, they know S3 is not going to let you go under and lose their $2 million. They're going to come in and backstop and give you $500,000 more if you need it, another $1 million more, or help bridge you to the next round. They know these guys are going to do that because they're not going to let their portfolio fail for some, bridge or whatever. And so they're banking on that. And so they know they won't, so they come in with debt, and they're secured on all the assets of the company. So they sit in front of the equity, on top of it, right? Because they're secured in all your assets. And they'll give you really great deals, like no amortization for 5 years. Like it's a bullet, 5-year bullet. Or no amort for 3 years. Or, so really attractive amort. So it's kind of like, it just sits, you get the cash, it sits there. But there's closing fees, like 3 to 5%. They want warrants, 5 to 7% warrant coverage, and I'll explain what that is so you guys know in a minute. And then an interest rate, so like the effective rate with all the crap in it, like there's all kinds of things, fees, hidden fees. It's like about 16 to 18%. It's very expensive, but it's no payments for like 5 years. Like that's pretty awesome. So if you're in a position where you're like, I need the capital, and we can come in behind these equity guys and lever up the company and provide more. Anyway, so there's reasons to do that. On the equity side, obviously, Angel's Family Offices, Angel Network, C10, Capital Factory, Geekdom, all these guys, they're all great guys, where they, aggregate people together and help accelerate stuff. Venture funds, I'm sure you guys have all knocked on at least 100 doors. The rules are you got to knock on 100 ugly frog doors to get like 2 or 3 of them to talk to you. The odds are really tough. I'm working with a company right now, and they're trying to raise a $20 to $30 million round. We have an investment bank engaged, very reputable investment bank engaged, and they're good. I mean, they're a good company. And we probably talked to about 50 VCs, and we've got further than first or second meetings with 3 of them. So it's tough. This is tough. People think, oh, venture, I'm just going to get some venture money. I'm like, good luck. Down here. On the West Coast, I think it might be a little easier because the connections are a little different, but down here, it's hard. I'm just being honest. At least my experience is that it's hard. Private equity and public equity, we talk about that acres and acres worth of discussion, but y'all are all too early for that. But the difference is they're both exits. They're both takeout strategies, whether it's a private or public investors, they're both takeouts. Okay, what kind, when, and why? Okay, we kind of talked a little bit, but so you guys, I'm always telling you that, it's hard, right? It's really hard to get money. So early stage is difficult, and only specific types of deals work well, right? So like angels and venture and some debt does, and convertible notes, and we'll talk about all these things. And commercial banks want revenue traction, almost always, and they want the ability to pay, or they want personal assets or a PG, which some people have to do. I mean, you can get a You know, you can get loans with PGs and you can get them. Angels can buy into your vision, and venture partners will take big risk on the market disruptions. The venture guys, obviously, they're all about the management team as well. That's what they're betting on. But more than anything, they want the market and the disruption opportunity. That's like usually they're looking for, you know, 10, 20, 50 times their investment, whereas an angel will be happy with 3 times their investment, right? So they're looking for someone that will hit a nice 5 iron, and versus the venture guys, and they're like, we do 10 deals a year, and you've got to be one and that we think is going to blow it out, right? So it's a little different strategy. So your needs and types of funding that make sense change. That's important too. So y'all are sitting right here going, okay, I need the next, you know, $500,000, or I need this to go to market, or I need this. But in 3 years, you will have a very different thing in your head you need. It'll be very different. You'll need something totally different. And you need something different 6 months ago, you need something different. So just always be open and don't allow yourself, especially in finance, because people tend to get stuck, like this is the only way to skin the cat. There's a million ways to skin the cat. I've raised a lot of money with my customers, like doing a deal where they prepaid this and we gave them some warrants and just move the P over here and there's pot P over there. And so just be creative and be open, because depending on where you're at in your company's life cycle, there could be something really interesting you could do that you hadn't considered, or that you move up in the chain and now you're talking to these kind of guys, and you just need to be more educated on how what they're interested in, and your talk track changes, right? So always think outside the box, okay? Okay. So now this is super boring. I talk really fast. I talk a lot, but I'll try to not bore you too much. Okay, so I'm just going to go through all these different types of things and say, hey, this is what this is, and this is how it works, you know, and tell you the good, the bad, and the ugly about it. So we're going to talk about debt. We're going to talk about all these types of debt. Small, and we're just going to go through them, but you'll see there's probably others too. So the rule in financing is if there's a deal to be done, there is someone who will do that deal. Somewhere you will find them. If you keep looking under every single rock, you'll find the person who will do your deal, even if it's weird or crazy. But these are some of the very basic debt financings. And I've done all of these, lots of these. And I have preferences, but obviously. I'm going to give you some terms. This is a really boring deck, because what I'm going to do is you're going to have it for like a reference book. It's like a reference. You're going to be able to look and go, okay, when someone says something, you go, what the hell is that? You look up. You don't have to Google it. Well, you can Google it, but. Okay, so here's just some words. Amortization, you guys all know what that is. You've got mortgages and cars. Security interest means if they have a first lien security interest, if they have a subordinated interest. Security interest means they have rights to all the assets. And if it's the first lien security, that means they're first in line. If it's subordinated, it means they sit behind the first lien in line. PG, they'll say PG, it's just a personal guarantee. It's just you on the hook for whatever you're borrowing personally. Balloon and bullets, I think y'all know what that is, but just a big balloon payment somewhere. It doesn't have to be at the end of the note. It can be in the middle of the note. It can be every 2 years, or it can stagger, so it doesn't mean it's at the end of the note. Warrant coverage. So I'm going to talk about this because some of you haven't done a warrant. So these are my favorites. These are my favorites because they're kickers. They're just kickers, and they only really work if you're. So how many of you are? So a lot of things depend on how your incorporator is structured. So how many of you are corporations? How many of you are LLCs? Okay. So when you're raising money, I should talk about this first. LLCs depends on who you're raising them with, right? LLCs are great for angels and family offices because, convertible notes don't help them so much because they're lenders and they're not getting attacked. They're not getting a K1 in your losses. But if you go to an angel and say, hey, you're an equity investor and you're going to get the losses, you can even do things as an LLC where you have, and talk to your tax people, but this is what I do, where you have your angel, you have an angel and you want to give a kicker to them, you can say, hey, you're going to own 10% of the company, but for this next year, you'll get 80% of the losses. Because you can give them all the losses in your company, even though they're only 10% owner, and they get this huge tax benefit in the year that they invested. So sometimes they can get almost all their, depending on how many investors you got, and how important they are, they can get a lot of their money back, that they invested up front in a tax credit, which is great as an LLC. As a corp, you can't do that, right? Because you're different. What you can do with a corporation is you can give people warrants, okay? And the way a warrant works is it's essentially like a stock option, okay? It's a stock option for non-people. So if you want to give someone a stock option, you give a natural person gets a stock option. And only natural people can get stock options. A corporation can't get a stock option. An entity can't get a stock option. But if you want to give an entity a kicker, you give them a warrant. And so what that does, so if I say, for example, I want 5% warrant coverage, that's what they'll say. They'll call it warrant coverage. And you'll say, okay, 5% warrant coverage. So if you're going to give me $100,000 in loans, or it's based on something, or, it'll be based on some, multiplier. Okay, usually it's an investment or loans or something, but it could be anything. It could be the value of the business. It could be anything, but it could be the clouds in the sky. But usually it's the investment. So I want a 5% warrant coverage. So you'll take 5% times $100,000 and you'll convert that to number of shares based on your most recent post-money share price. And that will be, so if it's $20 a share and they got 5,000, I'm bad with math, 100 shares, I'm bad with zeros, 100,000, how many shares that is, that's how many shares they're going to have. And they don't own the shares, they're warrants, so it's just like an option. They're usually 10-year warrants, and they sit there until you exit. And they can have a strike price, or they can have no strike price. Typically, they have a strike price that's equal to the last round, like the same. But not always. They can have all kinds of deals. You can make any kind of deal. PIK is paid in kind. That's what it means. That means you don't have to pay it now. You pay it later. Typically, it's used with interest. So I have a deal where I'm paying 10% interest, cash, 10% right now in a deal, and I'm paying 2.5% cash, and the rest is being PIKed, which means it's going to the note principal, and I'm not paying, and I pay at the end with a balloon, but it accrues interest on interest on interest, so it's very expensive. But you don't have to pay it now. SBA loans, some of you probably have had experience with these or looked at them. They're not bad. They're actually a really easy way to get your business off the ground. There's two types. There's microloans, which are like really tiny, up to $50K, and you can get those, especially if you're disadvantaged in any way. 7A is the most common. 504 is like a big, you got to be really rich and big buildings and big real estate stuff, whatever. 7A is the most typical. That's like when you hear people get an SBA loan, they got a 7A loan. It's really easy to qualify, really pretty easy, and if you're a woman or minority, it's even easier, and because the government backs these loans, so the commercial banks issue them, so like Wells Fargo, Bank of America, those are the guys who issue these, and it's just like a regular loan, only they do all this extra paperwork, so that, like lots and lots of paperwork, so that the government will back it, or at least they back a percentage of it.
Is revenue traction required?
I've never seen a company get one that didn't, but I haven't done a lot of them, so I don't know that it is. If you have, they're going to ask for a PG. So if you have anything, your car or what, a house, they'll PG you, and it's backed by the government, right? So this is the most flexible type of loan you can get, and banks will do them all day when they can. It's a ton of paperwork and takes a little longer to close, but it's good. And there's an ongoing reporting that's kind of a pain. But the payback, okay, so you can get like these long amorts, like 10-year amorts. Like you cannot get that. And Wells Fargo gives you a regular commercial loan. It's like a 3-year term note, or 6, maybe 5 years if you're lucky. It's probably 12 months. You got to renew it. So they're really cheap, super cheap, interest rate wise. So kind of attractive, complicated, bunch of paperwork, but that's what they're there for, to help small business get off the ground. Asset-based loans. So these are usually offered by commercial banks, finance companies, etc. This is when you have anything that you want to get a loan against. It's like an asset or a laptop or some equipment, or you have some equipment in the business, you can go finance that specifically. Or if you start getting some customers every month, they may lend you based on your receivable amounts and like calculate that and give you something based on that. They're really, if you have any hard assets at all, they're really pretty easy to get, like signature type, easy to get. And then and flexible terms, they may not require a PG. You may be able to get just on whatever you're financing, which is good. And there's lots of options because they're not regulated the same. The finance companies aren't. They're higher interest rates sometimes, not always. And then if you don't have any assets at all, it's not an option. If it's just all pure assets, that's not an option. Working capital loans. So these are, when you go to a commercial bank, and these are awesome, harder to get, but I'll tell you what they are. These are the type of loans you can get. If you get someone to come in and give you some money on the equity side, these are the kind that you might try to go get otherwise. So this is a working capital loan. So this is where you go to Bank of America and you say, hey, I want a working capital. Usually I always go to local banks. I don't go to big banks because big banks are like, woo. But like Fraud, not Frost, San Antonio banks. I mean, I go to like Bank of San Antonio. I mean, like, I got little tiny banks, you talk to the loan officer, like.
How do you feel about Bridge Bank in the Bay Area?
I do, there's a Bridge Bank representative here. Have you met her?
No.
So they are actually, I forget her name because I was drinking, but you can find her. So actually, Bridge Bank's a good bank, and they just started an office here, and literally they have one woman who is building a business here, and she's very aggressive, and she's like, let me have some names of people. They're kind of like Silicon Valley Bank. They're like tech bank, and they are being aggressive. I can't remember her name. I'm really sorry, but I'm sure you can find her here. And anyways, yeah, the downside. So these are really flexible. If you get a working capital loan, it's basically you say, hey, look, I need like $50,000, and it's a working capital loan, and they approve it, and they may make you PG it or whatever, and it just you can borrow, pay down like this. It's like it's like a credit card, but much cheaper. It's like bank rates. And it's usually 12 months. It's 364 days. It's not a year. That way they don't have to report it the same. And it's usually renewed each year. And then, so it's saying it's a bank. You still got to get approval for it. But it's only 1 year. So sometimes they're more flexible because they don't have to report it the same on their balance sheet. There's less risk for them. Term loans. These are the kind that are hard to get. Just so you guys know what they are. Offered by commercial banks. Finance companies do them too. Usually 5 to 7 years. This is like where you go. This is a car loan. I need $20,000, $30,000. I'm going to pay back over 60 months evenly every month. I'm going to make you a payment. And that's a term loan. Now, what you can have is you can have term loans where they have bullets and things like that, and you can push them, and they have 6 months, interest only. Like most SBA loans, for example, have 6 to 9 months interest only. And these guys sometimes will too, which is good. And they, anyway, so if you don't have any sales, these are hard to get, but that's what they are. Levered loans. These are the ones we just talked about where there's probably warrants are expensive. But almost every tech company that you've ever heard of has these. They all have them. Because the minute, this is just a learning thing, the minute you've got a venture guy on your cap table, a big venture guy on your cap table, the last thing they want is another $10 million in dilution coming in behind them. Like, if you need $10 million, they're like, let's put some debt on the company and let's do one of these. Because 16% is way lower interest rate than they're expecting in return. When they're expecting 30, 40, 200. Let's be real, like really high interest rates. So once you get to a point where you've got a big venture name in your cap table and you need more the next round or whatever you do, and you're doing pretty well and you've got this little trajectory, they'll want you to do this. And that's okay. It's totally normal. Every single one of them has it. I've had these forever. I've done so many of these, like so many. And every time I'm like, I'm not gonna have to refinance this one. This one's not gonna get refinanced because it'll be like 2 years, interest only, and then it's like starts amortizing at a really heavy clip for like 12 months. And I'm like, we're gonna sell this baby before that comes up. And I'm like, damn, I gotta refinance a loan. And I've refinanced every 2 years. So every 2 years, the last 20 years, I've done one of these deals. Like, it's crazy. But it's okay. These lenders of last resort, mezzanine debt. Okay. These are guys like the other guys, only they sit below those guys. So mezz debt is levered debt, same warrants, interest, bullets, all that kind of stuff. But they're not senior secured. So what happens a lot, they're subordinated secured. So they're still in, so you have, I'll show you, we'll get to that. Or no, I don't put that in here. Okay, so you have like the senior, you have like, you can have a stack where you actually have Bank of America, and then you got Triple Point, levered debt, and then you got this sub debt, ABC, break your leg guy, and then you got a Series D, C, B, A. I mean, you've got like this huge stack, and that can happen. And these guys are risk takers, super risk takers, and they ask a lot in return. And they do that because usually people get mezz debt because they're about to exit, and they don't want to go get more equity because it's like a bad idea because they'll be too dilutive at the point, or it's bridge stuff, or they can't get equity, but they've got a lot of assets or a lot of receivables, and someone's willing to step up and take a second position on those assets. So it's pretty expensive, and usually you've got to have the same thing. You have venture investor because then they'll come in because they know that guy's not going to let it fail because then they'll lose all their money. But that's what that is. So, and then bridge notes. And so bridge notes, I think probably everyone knows what kind of these are just by the name, bridge notes, if you haven't had one before. So bridge notes, fast to close, simple terms. They're always going to be friendly investors. That's just like, hey, we're about to close around. Think these guys are going to give us some money, and we're talking to them, and think it's going to be 3 or 4 minutes, and then you can get someone who's already usually an existing investor because they don't want to lose what they already have. They bridge you, and they just give you a bridge note. And so they're short term. The interest rates are kind of low, usually pretty low, like convertible notes. Sometimes they'll have warrants. They usually do have warrants with them because they want a kicker for just ponying up for 4 or 6 months because they're not getting a big return. So they want a little kicker for that. Sometimes they'll have clause in them. So if they're not paid off within this time, they convert at a really ugly rate to equity, like super ugly terms. So that happens. Yeah, so that's it. So it's usually with existing people that are already kind of in bed with you, so to speak. Okay.
Question on
Yes, sir.
the bridge note. Is the intention that whoever's giving you the money, they want it to be paid back, or do they want it to convert?
No, they want you to be successful. That's what they want. That's all they care about. But they have to have, like anyone, like any smart business person, they just have protection. They're like, most bridge notes convert. I should say most of them convert, but I wouldn't say it's because they expect. So let's talk about it. So on a bridge note, the dynamics normally are that you have an existing investors or some angels or someone in your cap table, and you're like, look, we're doing this deal. We think these other guys are going to come in, and we think it's going to be these good terms. We think it's great, and they're like, but we need cash for like 90 days. And they're like, okay. So what they want is they're like, first thing, they're like, yeah, we want you to be successful. We want you to close that deal. And we have faith. They have to have faith that you're going to close that deal, or they wouldn't do it. They're not going to give you more, not throw more, bad money after good, right? They think you're going to get it done. So they have high confidence. They give you the money, and they usually are willing to let it convert. Not that they go, oh, please let it convert. Because, they usually have a right of first refusal, or they usually have the ability to invest anyways in the next round. Like they've got preemptive rights and all kinds of crap, so they can usually invest anyways in the next round. But this way, so it's like their nod that, yeah, I trust you, you're going to do a good job. But in the event that you don't, for whatever reason, there are these certain things that protect us, and there's just some clause, little
People
clause.
usually use money from that next round to pay off that note.
Uh-huh. Or it converts. And so sometimes there have been situations, I've seen situations where it's heavily negotiated. There's a convertible note, or a bridge note, and if it's big enough that the new investors may force it to convert, right? Because they don't want the use of proceeds going. But if it's small, then it depends, right? If a big guy coming in, they're like, whatever, just pay it off and get them out. I don't want, I'm giving you $5 million. I don't want this $50,000 even in my tranche. Get it, pay it off, right? Or so it just depends on how big and what the dynamics are.
Okay.
Equity financing. So we'll start from there. And I have not done that. And I have not done that successfully. I don't know what the hell's going on with that. That world's a weird world to me. I don't get it. I'm trying to figure it out. The rest of it I've done, all of it. Okay. As always, here are some terms. So if you're an LLC, you probably have partnership units or partnerships, or you've heard of that. And so when you're an LLC, you're usually talking in terms of units or percent ownership, or you're not saying stock certificates, you're saying something else. So that's what that is. So partnership units and percentage and rights. So the rights of losses and income distribution is a really cool tool. Don't overlook that tool. Don't just let your accountant be like, oh yeah, you own this much, and everyone gets their percent they own. That's how the K-1s come out. Don't do that. Use that tool when you can, because you can really help get people across the goal line by saying, hey, we can do this, and you can have someone take all the income, you can have someone take all the losses. You can do some cool stuff with that. And people and angels love losses. I mean, they don't love losses, but they like them when they're coming in like that. Stock. So literally stock certificate, right? So people, sometimes it's always funny. The first time I work with people and I'm like, here's your stock certificate, with like founders, and the first time they're signing stock certificates, and so-and-so bought 1,000 shares, and they're like, it's just one piece of paper. I'm like, yes, it's one piece of paper, and it says 1,000 on it. I'm like, no, I'm not going to give them 1,000 pieces of paper. People, I don't know what they imagine. I'm like, it's funny. I'm like, yeah, it's like there's this big vault of stock certificates. No. There actually is, but they're like, it's not like that. Anyway, it's pretty funny. So, so let's talk about stock for a second and classes, and we'll talk about stock right here a little bit, just stock, classes, and preferred stock specifically. And then we have a little bit more on preferred stock to follow. So how many of you have issued your first Series A? Okay. So your Series A, when you guys get to that point, so when you do a big round, so for all you LLCs out there, when a VC comes to you and wants to give you money, you're going to convert to a corp. You're not going to stay an LLC. And don't even, just let them do that, or do it before, but then you lose your taxes. So just, that's all part of the thing. It usually happens all at the same time. But you will convert to a corp. Or you'll make a corp and you'll shove the LLC underneath it. Either way is fine. And you'll issue preferred stock. Okay, so preferred stock, there's common stock is what all of you own. You C Corps out there own common stock. You own founder stock. It's common stock. It's very common. It's the commoners. It's the founders. Sorry, you're at the bottom of the stack. Sorry about that. They're like, well, but I built it. I'm like, yeah, and you built it, and you're the foundation, the very bottom of the stack. All your sweat equity is worth this much. But everyone that comes on top of you is so typically preferred. I never see people come in ever. I've never seen common come in unless it was some weird deal. But they're always preferred. And so preferred stock comes in, and your first round is preferred A, and then preferred B, and then C, and you can have a C-1, -2. You can have all these things. I think Uber's on I talked to a guy who was like, oh, you want to do an Uber round? You want to invest in an Uber round? I got this level. They're like on their preferred Series X or whatever. I'm like, oh God, X? No, I don't want to invest in an X series. So there's classes. So a class of stock is common and preferred. Those are two classes of stock. Within each, common's just common, but within preferred, there are series. A series, B series, C series. Okay, so preferred stock, here's how it works. It has all kinds of rights. We'll talk about it in a minute, but the types of rights it has preemptive, it has ROFRs, it has blocking, anti-dilution, on and on and on and on and on, pages and pages of rights, some of them very specific to you. You can have ones that say if you hit certain revenue numbers, we convert at this rate. I mean, there's all kinds of it's called ratchets. I mean, there's all kinds of things you can do to get people interested and willing to do a deal with you. So be creative, be willing to listen. A waterfall, people say, what's the waterfall? The waterfall is the way the money goes down, who gets what first, in what order. Yeah. Okay, and there's pre and post money. So we'll show you examples of a cap table in a minute for you guys who haven't seen a lot of cap tables. But pre-money is easy. It's like, what is a company worth today? Before I put any money in it, what's the company worth? I think I'm worth $1 million. Okay, your pre-money is $1 million. If I give you $500,000, your post-money is $1,500,000. Pre and post. It's very simple. It can be a little bit more complex on the cap table, but that's the simplistic argument. It's really by shares, but that's the easy way to think about it. Pre before and then post after the money's in, it's worth whatever it was before plus the money that just went into it. Okay. Convertible notes. I think most of you that's probably all you guys probably have a term sheet in your back pocket. You're walking around with convertible note term sheets. Like every good founder's you sign right here, you can give me some money, and you're in, So those, simple. Paperwork. Everyone knows what they are. Any investor that is worth their salt will know what a convertible note is. It's super flexible terms, provides time to grow your business. And the reason people use them, the reason you use them, is because you're not ready to price your round. I mean, that at the end of the day, it's easier to get done because it's smaller paperwork and you can get your grandpa to sign one and give you $5,000 and that's great. But at the end of the day, the reason you're doing it is because you're not ready to price it. And there's no one standing up saying, I'm a sophisticated investor and I'm going to price this round. The minute you have that, you're not going to have a convertible note. You're going to have an equity round.
You're saying pricing the round. Is that based on your valuation?
Yes, sir. So enterprise value, so I didn't put that up there. So I'm sure you guys all have heard that, or your enterprise value. But the simple math for enterprise value is it's your stock shares or your ownership per units times the value that someone's willing to pay for those units. And the only thing you do from that is if you were going to sell your company, it would be that number, the shares times the price, minus the debt, plus the cash. And that's your enterprise value. And so when you look at public companies and you see their enterprise value, they've done all that for you. They've netted out what the real value, because whoever buys you, someone pays. So if the investors or the company's worth $1 million, but I got $50 million in debt, then I'm really only get $50 million. So the enterprise value really is what it is, but you get that much. So that's how they're communicating to you the value of the company.
I may be jumping ahead. Are you going to talk to me about valuation and how to inform?
I'm going to show you a cap table, and then we can talk about that kind of stuff.
Great.
Yes.
on convertible notes, what about some of these other, newer devices like the Safe and the, there's another new one that I heard about recently that's kind of like a modified Safe.
I don't know what a
Safe is
safe
just a
is.
convertible note without the
I don't know what a safe is. I haven't done one of
the
those.
clock. Without, it's a safe is a convertible note without the clock.
There's no term on it.
Correct.
There's,
There's no term.
there's a
There's no
term,
term.
It's not
different.
dead, it's not dead.
It's not
called,
dead.
It can't be debt. Yeah, in order to be debt, it has to have a term by law.
Yeah, there can be a discount, but
There's
no
discount, but
interest
there's no term. When does it convert?
trying to think.
Never?
Qualified
Never.
financing.
And there's no other date that it converts. So I haven't done those, but yeah, it's like this, but just take out the section, whatever, with the term
We
on
were
it, I
offered
guess.
one from FBC when we were.
Interesting.
doing some-
I wonder if it's because they think you're gonna do a round really soon.
It was so, this was,
Y
when
Combinator
VC
is
was-
Interesting.
This was a VC that had kind of like a mission statement kind of thing about taking like university tech and getting it into.
Oh, yeah.
Thing. It was a
So-
decentralized.
So they're
VC
a
firm.
loving VC firm.
Yeah, so they were trying to, of course. I'm sure
Loving.
they all say that.
We're loving,
But-
we're
Yeah,
altruistic.
we really care about.
We care about the
small businesses.
world,
So
the environment.
They pitched it to us as a, basically a more founder-friendly version of convertible note. That was
Yeah.
how they pitched it to us, but then my CFO went looking, I can't remember what the heck the
I have
It's
not-
Simple agreement for equity, that's what it is.
Yeah, I have not done that.
For future.
Okay, so I have not done one of those, but it sounds like, so I've never had a deal where the term came and we didn't convert it, even if a qualified financing hadn't happened. Ever. And I've had that happen like half a dozen times probably. And they always convert because they have to. They don't have a choice, they're gonna convert. So I don't know if it matters, but I understand what you're saying.
Okay.
So if there's no valuation when you're issuing out the convertible notes,
Yeah.
when it converts, how then does the investor know how much it's going to get or how much equity it's going to
Right.
get?
So a convertible note, here's how it works. So, so you have a convertible note, and it'll essentially say that you're going to give me $100,000, and I should put an example, a mathematical example. I did not, but I can probably add one to this before I send it over. So you get a $100,000 convertible note. Okay, it's a 5% discount and a 15% discount, probably, and a 5% rate. That would interest rate. And so, and it's out for a year. Okay, so the 5% you're going to get, so it's worth $105 at the end of the year, 5% interest rate. And then let's say the qualified financing. So the qualified financing you define, right? So you can say this note, it says this note is going to convert at the earlier of a qualified financing, which equals of at least $1 million in equity, in some type of equity, or 2 years. So it's going to convert at the earlier of. So in 2 years, and usually it says you're not required to convert it because otherwise it would not be debt. But everyone converts them. And they know they're going to convert. That's just how it works. So at the end of 2 years, if you have not had a qualified financing, you will what typically happens is the company will put forth a term sheet. And this is what we've done. I've done. I just put forth a term sheet and said, we've done, you convertible note holders, we've done the analysis and we believe the fair value, enterprise value, and the price per share, because, we have however many shares are pre-money, right? We have 1,000 shares today and we think our company's worth $1 million, and so our pre-money is whatever that is, 10, 100, whatever, per share, whatever that is. That's what we think the company's worth, and we're going to offer you to convert your notes into this round. This round may be nothing but you converting in this round, right? It doesn't have to be anybody else. It's just this is a round that we're closing on, and they'll convert because they're out of luck because they're unsecured and whatever. Okay, I guess I'll convert. And so they convert, and they'll convert it at a discount. So if it's $10 a share, if the value is $10 a share, effectively, we think that's what the company's worth, and they have a 15% discount, they're going to convert at 8.5. So you're going to take $105,000 divided by $8.5, and that's how many shares they get. And then that'll be added to the cap table. And so now your post money is the million plus whatever they converted at. And they're going to convert it more than 105 because they got the discount. So whatever that net effective is, your post money is going to be more than 1,105,000. It's going to be like 1,120,000 or something. I can get some math. I'll do a little thing, but that's how it works. And so the advantage, they get the discount, and sometimes there's a cap, there usually is, so they get the advantage of, they're going to invest in you now, and you're like, look, we're not ready to price around because we're having so much traction right now, and we don't know because there's not a good comp for us. but we believe we'll have a big round. We'll close one within the next 2 years, and so we want to price it. We're going to price it then, and you're going to get a discount to it, which is great because you're going to get lower because you're taking the risk earlier on. And by the way, in case we totally blow up, like we know we are, we're going to cap it so that no matter what, you're going to convert. Let's just say we're going to cap you at $2 million valuation. So that means when you convert, even if the company raises money at a $10 million pre-money, we're going to convert you as if the company was raising money at $2 million valuation. So they're going to own a big ass chunk of the company. Now the challenge with that, now this also happens. When that happens sometimes, the guys coming in, putting new money in, can force those guys to convert at a different rate. And that's happened to me before, where guys have come in and have had to negotiate the convertible note holders and the Series A guys, because the Series A guys are like, I'm not going to do that deal and have them convert at a $2 million pre when we've got a $40 million pre. We're not doing that. So they've had to bridge and meet in the middle, and so that's the and money. Here's, like I said earlier, if there's a deal to be done, it can get done. All this like, well, this is exactly how the terms of an agreement work. And that's bull crap. You get something done, you get people excited, and you hope that everything goes your way and that you never have to, nothing bad and the agreement happens. But I've signed a lot of deals that were really they had some ugly stuff in them that I knew I was going to have to go deal with later. But hopefully I'd have someone around me helping me with some good story so that when I dealt with it, I'd have a positive thing and it wouldn't be so bad, and they would negotiate. And sometimes they don't, it's really crappy. But sometimes they do, you know? Yeah.
The cap sometimes looks and quacks like a valuation. Can the cap, if you set a low cap with somebody on a note, can when you get to qualified financing and you're doing a Series A, do they look at that and be like, well,
No. No. I shouldn't say that. Maybe they do. I've never had anyone say, well, we don't think you're worth $10 million because you were thinking you were only worth $2 million. I'm like, yeah, 2 years ago before we freaking rocked it. I mean, yeah, 2 years later, hello, you know. Like I could see if you did it today and then 30 days later you close on a big Series A, you might have that issue. But even then, you always have the argument, hey, these are angels and they took the risk, and hey man, this is what we did. We had to get a deal done. You know, we know we're worth more. That's why we didn't freaking price it, because we knew we weren't going to raise a big round and price it because that was too diluted for what we were worth. I mean, you can make if you have a smart finance person, you get them and they're like, oh no, we're so great, and just yeah, you can do it. Don't let them. They'll make any argument, but you can always make. Where there's an argument, there's always a counter argument, right? Always. Common, that's all you guys. It's the lowest thing in the waterfall. Not the lowest. There's options and warrants below that, but it's the lowest thing in the liquidity event. Sometimes though it can pay out even better than the preferred, and I'll show you that as an example. But it's at the bottom. It's owned by the founders. Typically, you can issue common. It's usually by founders, because once you issue common and you have a valuation or something, you try to give it to someone, they have a taxable event and they've got no wherewithal to pay, which is why you don't usually see people issuing a bunch of common stock to new people 3 years after you found the company, because there's some risk of tax risk. So that's typical. And then usually common a lot of times doesn't come with any cash. It's like you get common and you get some common, and we're going to all share the common because we're building this business. And you can give, and that people use that early on, right, to get people to come help you for very little money, and that's what you do. And then usually your ownership and voting rights are the same based on your percent ownership. I mean, you may have you don't have the preferred rights, but it's based on ownership, so you still have a lot of rights in the business. Preferred. So we talked a little bit about preferred. Let's talk about the thing that is, let's talk about the rights of preferred. Did I list rights? I'll have another slide in a second. Okay, so very familiar. Any savvy investor, you can say, oh yeah, we're doing a preferred round, a Series A. They know exactly where you're at in your life cycle. Like they know, okay, you've got a little revenue, maybe a little bit, and we know where you're at. Series B, okay, yeah, you're starting to grow. Series C, you're a growth company. Series D, you're late stage growth company. Series E, F, you're like, crazy, you need to do an IPO, but you're not there yet or whatever. So it's some lead time to get that money closed. You have to kiss a lot of frogs. You give up control, you give up rights. It's expensive with the preference. But it's usually validating money. That to me, and then once you've got a good preferred investor, like a good preferred investor, venture type, they always have some dry powder. So when you have to go back to the well, they're there, and that's helpful sometimes. They usually play in every round. Like the first guys that come in first, if you've got a reputable venture capitalist, they have to play in every round, or another round can't get done. Like if you have a venture company you've heard of, if you have them in your cap table in your Series A, when they do the Series B, if they don't participate, that B won't get done. Because they'll be like, why won't you put more money in? What, is this a piece of crap? What, are you lying to us? What? Like, you've got to play. They have to keep playing. And if they're not playing, they have to have a reason. And usually they're pro rata. So if they're not playing, it's like, oh, our fund is end of life, and there's some BS reason why. There has to be. Not has to be, but it's very political.
Does the lead always have the biggest?
No, the lead does not. As a matter of fact, you get any old soul you can to give you a term sheet, and that's your lead. Do not worry about it being, oh, they're so big and strong. You just get a term sheet from someone who's willing to put money in your company and say, hey, here's what I got. And, can't be $20, but it can be anyone. It can be just an angel who's willing to bet on the company. And you've got a term sheet versus you making your own. It does not have to be the biggest investor.
So, with my last startup, we did a Series A that had like 4 tranches, and then when we went to go do Series B, our VC wanted us to bring, they claimed they wanted to bring in a second investor because they said that they were able to fill the round B, but they wanted a second investor.
Yeah, they need more dry powder.
Series C and D.
Yeah, right. They need to lower their pro rata. They've got to bring themselves down. They can't.
And we were successful.
Right.
We
Yeah.
did that, but is that is what they were communicating to us the full story? I guess is the question. And I wasn't really in those.
No, I don't think that's the issue. I don't think that's the issue. I think, there are times. I mean, certainly, every fund has rules about how much. Like, so for Sequoia is an example. So in the fund we were in, my company was in, they could only do $50 million in any one company in that fund. That was the fund's bylaw. So they have bylaws and things, and they have so many years. Like, you can only invest in one company up for so long, and then there are rules. So so it's not just that. And sometimes they'd say, well, your next round is going to be a $30 million round or $20 million round. It's going to be a lot bigger than this 10 or 8 or whatever we just did. So we need to bring in some more players because our fund and we have a $30 million fund. We can't put $20 million of our fund into your deal. So they know they have to bring more guys in, but it's not. And then the next round they are going to participate. They will participate because else it'll be hard to get done. But they may have reasons why. And those guys out there all know. I say guys because literally it's all guys, but they do know. They know each other. They're like, oh yeah, that's that fund. They know. But you got to nod and participate. Okay, let's talk about. I did want to give you. Okay, so these are typical rights. There are so many rights. They can make up. They can say, well, if the clouds are blue that day, then we get more. Then we convert at 3 times our money. They can make up some BS stuff, but these are the most typical. These are standard rights, and you'll see this in almost every boilerplate. You'll see all these rights. Okay, so liquidity preference. This is important. Okay, the preference is the amount that they've invested. So when they say liquidity preference, what they mean is if they put $10 million in, their preference is $10 million. People walk around saying, oh, the preference. And so people will say, how much preference is in your company? How much preference is in your company? Well, the preference of the company is the total amount of preferred equity we've raised. That's the preference. Now, how it's paid out. It can be participating or it can be non-participating preferred. Okay? It's very important. You do not want participating. You don't want that. Okay, you want non-participating. And it seems counterintuitive because participating is a good thing. No, it's not this. So what it means, participating, and they'll say they'll say a 1 times preference or 2 times preference or whatever. They'll say some numbers like 1 times or 3 times multiple, whatever. So the 1 time, obviously more than 1 time really sucks. That means they're going to want at least, if they would say 2 times, they want 2 times their preference at exit. But whether it's participating or non-participating is sort of the second question. So they have an amount they expect, their preference, back. So when we exit or sell the company, we get our money back first before anyone below us gets their money back. We get it all back. I know the debt guys and any preferred stock on top of us, we understand they may get their money back first, and then they get their money back first, and then we're sitting here and we get our money back next. We're in the waterfall. And if we're participating, what that means is, so if I put $10 million in, I get my $10 million back, and then whatever percentage I owned with that $10 million, say I own 20% of the company, I also get 20% of whatever's after you pay back the preference. I also get 20% of all the rest of it taken out of the commons pocket. Give me 20% on top of I get my $10 million back. Thank you very much for the loan, and I get the 20% of the company, whatever the valuation is. So that's participating. It's not pretty. It's really sucky, and it's not as common, but it used to be. Non-participating is not that. What non-participating says, if it's non-participating preferred, it means I get my 1 times or 2 times or whatever. I get the greater of that number, or as if converted to common. So if you just converted me to common, like I'm 20% of the company, if I convert 20% of the company over, and if that number's bigger than my 2 times preference or 1 times preference, then I'll take that number instead of this number. I get one or the other. I don't get both. Whereas participating, you get both. Preemptive rights is when an investor has the right to purchase additional shares in the next round. And so they always have rights to do this, and they almost always do that. Like I said, sometimes they don't want to, but they know they have to. So that's kind of, and they usually do their pro rata. They have the preemptive usually is up to their pro rata, their same percentage. The anti-dilutive rights, so if you raise a round today, and then in a year you raise another round, and the share price in the next round is lower, goes down, then the guys will get, they will get their price ratcheted down as if they were in the next lower round. So you don't get to screw them and say, oh, you had to pay $20, these guys paid $10. And it's not always like you get all the way to $10. Sometimes it's a ratchet or some sort. But they get rights where they get down. So then their shares now, instead of having 100, they've got 200 shares or whatever. They get anti-dilutive, they get grossed up. Blocking, they can block anything. M&A, raising money, raising debt, board members, whatever, all kinds of blocking rights. Okay, warrants. We talked about warrants. Options are employee options. If you guys, they don't give you money, they just give you more help, and I can explain those if you guys would like, but they're pretty simple. At the end of the day, these are kickers, and they don't usually come with cash, but they incent people, and sometimes people and partners are just as good as cash. Like, I got to pay you 50 grand a year, okay, or I can give you this and I can pay you 10 grand a year, so I don't have to get the 40 grand, and you're willing to take these. So they're kind of like your trading, your trading cards. They are dilutive. There's paperwork, accounting, management stuff you have to deal with them.
Is there an equivalent for that for LLCs?
Huh?
Is there an equivalent for LLCs?
Yeah, so the interesting thing about LLCs, I should have said that. The interesting thing is LLC, you have to give them partnership units. And you can put in there, so LLCs are super flexible, way more flexible than corporations. So you can make any old thing if you want. You can say, you're going to get...
Limit to the number of, is it just members that are limited?
No, they can be, they don't have to be members. Well, they are members, but they're not managers. So they have to be members if they're owners, but they're not managers, so they don't have any rights. So you can give someone partnership units in an LLC and say, you've got 100 partnership units, or you've got 10 partnership units. And you can tell them how much or not that's worth of the partnership in total, and they're a member now, and they'll get a K1, and they'll get all those things. But they won't have, they're not not a manager, they don't have any rights. And you can even put in their partnership agreement that these, you will earn these over 2 years, and if you stop providing services within blah blah, then you relinquish blah 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 blah. You can just write any old thing, really. LLCs.
What's the K1?
Okay, so K1 is so in an LLC you have because it's a pass-through entity, right? So if you have losses, let's just be real, we all have losses. Okay, we have losses. If there's $100,000 in losses, those losses are distributed on partnership K1s. It's like a document that attaches to the return of the LLC, and that K1 is sent off to the various partners, and they file it with their personal tax return, and it becomes additional income or losses to them. And so if you have an angel, and those percentages, what you say in your tax return is you say, Joe Bob gets what percentage of the income and what percentage of the losses. And you can make those numbers up. They're usually the same percentage ownership, but they don't have to be. They can be different.
Oh, great, yeah.
And so you have some flexibility. And then so if there's 100,000 loss and Joe Bob gets 20%, then he gets $20,000 in losses, and he takes it off his income. So now he's going to get 10 grand back, or whatever his incremental tax rate is, back on his tax return.
Right.
So it's very, very useful.
Yeah.
You can give the guy money back.
Yeah, we're guaranteed to lose $225,000.
Right.
From
So
a grant.
you can, right. So you have an angel come in and you say, look, here's the deal. You want to come in, if you'll give us 100 grand, we will give you we'll give you 50% of losses. So you're going to have 100 grand in losses come in.
Yeah.
on your tax return this year. And those angels are like, really? Yay. And they don't even think about that. But that's a way to get them to sweeten the pot.
So what's the benefit of using the LLC function with a bunch of different partners versus doing an S corp since they're both pass through?
So I've done S corps, and S corps are normally, I mean, I think they're kind of old school. So they're normally done when you have one or two managers, or one as an example. So if you owned a company by yourself and you had an LLC, you're going to be a sole proprietor, and you're going to be taxed like a sole proprietor unless you file as an S corp, because you have to. An S corp it can only have natural people. It can't have entities it can't have corporations investing in it. So it's more limited. Like an LLC can have you can have other things in it. So like if you have a bunch of inks and corps or things or weird entities, S corps are kind of harder, and they have to limit to, I think, 100. There's a limit on number of investors. An S corp, it's 100. So there's some limits. So I think it's sort of I don't think it's as common now unless you're kind of a single shop LLC. I think it's less common. A lot of tax accountants, you used to be an S corp. I'm like, no, talk to your finance person first before you decide to just go with whatever they say. Yeah, so ICOs, I have not done one. I don't know that much about them. I have companies all the time go, I want to do an ICO. All right. I'm like, okay, let's talk to somebody. We'll talk to them. I'm like, gosh, that sounds like some hard-ass shit. I don't know about that. So I'm not sure. If any of y'all done one or tried to do one, how was it? Painful. Yeah, that's the sense I get.
My business partner sells insurance all out in the country.
Right. They're weird. And I think so I would say, as a founder, you're going to get a lot of people that ask you. So one thing that's interesting, you're going to get a lot of people that ask you to do an ICO. They're interested in helping you do an ICO because it's like this new thing, right? Everyone wants to do an ICO. I'll want to do one at some point because I want to learn them. But I just know from talking to people who try to do them or going through kind of the diligence process and perhaps doing one, it doesn't work for most. It doesn't work for most companies because you've got to have a product offering that works well with an exchange. You're giving something and they're using it. Like it's something that you can trade. And the regulations. And there's ways to get around some of it now. There's some ways like you can do certain types of things. The regulations aren't as tough. They're worse, I think, a year or two ago even than they are now. But most companies, I think, unless you've got something that trades well, like you're giving a service that people can trade and share, and there's like the blockchain, all that, unless all that kind of works for your company's business model, it's probably not the right thing just based on the business model aspect. It's complicated. It's a lot of work to set up. There's sometimes a lot of capital up front to do it because you've got to build, you've got to enter a market, and you have to create a coin, all this work, lots of scammers, regulatory environments totally in flux. Anyway, so I haven't done one. I'd like to learn the backs of somebody else. Anyways, and IPOs, hopefully y'all all do one. They're really fun. They're a lot of work. So let's, go IPOs. Okay, and that's it. So what I want to do, I'll just give you this real fast, a cap table, and then we'll be done because we're almost at an hour. Oh, I'm sorry. I want to have, if you have questions, we can talk about more questions. But real quick, here's an example of a later stage cap table, just made up stuff. Not later stage, but you've got a lot. You've got two, a Series A and a Series B. So list the shares right here, okay? Pretty easy. And this is % fully diluted ownership, okay? Now you'll notice the common, there wasn't any money raised in the common. That was the founders. They had 10,000 shares between them. They originally owned 100% of the company. They gave some away. They only owned like 18% of the company. This is not atypical. And then the preferred guys came in 15 at $20 a share. And they gave the guys $300,000, 25, 30, 750 grand. That's great. They issued some warrants to some customers along the way. They gave them some warrants. No money raised, but those guys now own almost 2% of the company. It's their biggest customer. And employee options, right? And those guys, and option pools are almost always, not always, 7 to 10% is typical amount of percentage you'll have for your option pool. And if you have a venture guys coming in, they will require you to up your pool before they come in because they don't want to be diluted by it later, and they know that you're going to issue them. So usually as part of the round, you'll up the pool to 8 to 10%, sometimes even higher than that. Sequoia required us to have 15% on hand before they do any round, which was very dilutive to us to do it. You don't have to issue it all, but you got to have it reserved when they calculate their pre-money or their, So here's how. Let's just give an example. I made some crap up. So the Series A pre-money, let's say in the Series A, there was, when the Series A was done, there were 16,000 shares, 10,000 common and 1,000 warrants. I just decided when they happened. So there's already 16,000 shares, and at $20 a share, the pre-money is $320. It's not the same, so it's $320 is in pre-money, right? They invested $300 at $20 a share. Post-money is $620, right? They invested $300. $320 plus $300, $620. That's the post-money. Pre-money, they're going to look at your total shares times their rate. That's the pre-money. That's your post-money. The Series B guys came in, and they said, how many shares are outstanding? They said 31,000 or whatever. There's like 31,000 shares outstanding now, right? The pre-money, wait, oh, I didn't do this right. Sorry about that. Hold on. Wait. Pre-money, post-money. Is that right? Oh, wait, maybe I'm crazy. 16,000 shares, 56. Oh, yeah, so the series, is that right? 15, 25, yeah, 31. I can't count. Okay, so 31, I'm sorry, I'm going crazy. So 31 is the total number of shares before the Series B, okay, like 56 minus 25, 31,000 shares. The pre-money, they're going to say the company's worth 31,000 shares times $30 a share, which is what the company's worth. So the company's pre-money at the Series B was $930. So this $629.30, that's where you added value to the company between rounds. You added this much enterprise value to the company. So pre-money's here. They invest $750, and now you've got a post-money up here. Okay, that's just that example. Here's a waterfall. In this example, you sell the company for $1.5 million. Say, hey, we're going to sell the company for $1.5 million. Someone offers that, we're just going to take it and go, whatever. And the debt balance is $100K. That means we've had to pay off $100K, and there's $1.4 million. This is what a waterfall looks like, just like this. Everyone gets their stuff. It looks more complicated, but this is how it works. $1.4 million, and the Series B guys, they're next because last in, first out. $750. They get the greater of. They invested $750. Now, if I took 44.6%, I didn't do it. I should have done this thing. If I took that times this, I don't know what the number is, but it's less than that. Okay? So they're going to get the greater of. So they're going to get all their money back. And so that's $650. And the Series A guys, they say, well, everyone that's left, if I divide up all our shares, which I should have done that for you, I'm sorry. If I divide up all our shares and we all split it based on our leftover percentages, what do we all get? The Series A gets 314, which is, they would get 314, which is more than their 300. So they get 314. And then these guys, and then the common, they get their percentage times the 650 options. The options, I just said they're at 0 strike because that's easier to calculate. They get theirs. And the warrants, they're out of the money. Actually, the common gets what's left. The warrant, the options are up, they're like common, same as the common guys. The warrants are out of the money because they're up here. So that's usually the order of things. But here's the deal. The options and the common, they did pretty well compared to the Series A. It's really weird. So here's the deal with math, the math on the waterfall. You can have a situation like where the guys in the bottom of the stack are getting screwed if the valuation's not high enough to pay everyone more, more than their amount. But there's a tipping point where if the company sells for just enough that the guys at the top of the stack just get their money back, then that leaves more for everybody else. And it happens. And so if we'd made, I don't know the numbers, I could do sensitivity, but it was like $1.7 million or something, the common might actually get less. Because all of a sudden the Series B would be participating and getting more back than their return. So there's some interesting math in the waterfall. So it's always good to have scenarios about how it works. And once you have a lot of investors, you're like, hey, what happens if? So that's all I have. That's me. That's it. And it's 3:30, and I'm sorry we took so long. It was like an hour. Questions? Yes.
I have yet another question on past due taxes.
Mm-hmm.
Can we also pass them through to the next year for us?
Not really,
Is it
no.
a use it or lose it thing? So
Yes.
if I know I'm gonna have this loss this year,
Yeah,
I need to get an angel and get him or her on board because I
yeah.
got this year only, basically.
Yeah.
Okay.
Yeah. It's just a tax-based accounting thing. Yes, sir. Yes, ma'am.
Do you have any thoughts on best ways to compensate? We've got a few team members who will be working for equity only before we raise our seed round. Any thoughts on best practices for that?
Yeah. So what I've done in the past. So obviously, common stock and options and all that's good. And if you haven't raised around, you know, the options can be priced at basically par. You know, point. If you haven't done a 498, you don't need to do one yet. That's good. And then also what you typically can do is you can have triggers based on the next round. You can have like performance bonuses, and you can have, you'll go into this thing, or you get more stock, or you get more options granted at that date. Or if something happens, we can accelerate certain options. We can accelerate them for you and have them vest sooner. Or, you know, you can do a lot of things like that. And what you're doing is typical. Options, and then, you know, people love cash, so find ways to do cash when you can. But yeah, you can do some stuff with the options to accelerate and to have them vest more quickly earlier on, so they feel like they're getting something sooner.
Yeah, I think that's what we're looking at.
You can do anything you want with vesting. You can do any.
Yeah.
So what you have to issue them at the value they are today by law, but you can have any vesting you want. You can have them all vest today if you want.
So the
But that's
value
stupid.
that they are today, that we haven't raised anything yet, is the same
You-
as what, like,
It's par.
which is what
Point-
we paid, or?
0.00 whatever
Okay.
1 or something. You need to document that that's what you believe it is, because you haven't had a round and you have no basis to form evaluation, because the IRS 498 will come in and, like, you know, there's some laws around that. But as long as you've got it documented, you can do that.
Okay, so they don't have a big tax bill.
Right.
Yeah, now.
Now, right.
Yeah.
And you can give them restricted stock, or you can give them, which is, you know, there's no sense in giving them restricted though if your options are, if you're low price today. Restricted stock is like giving someone options, but giving it zero basis, you don't have to pay for them, but there's a tax implication to that.
So
It's not
that's
as great.
something you might do later.
Yes. And you'd have them, there's ways to get around the tax laws, but, you know,
How is
yes.
total shares determined early phase as well as later stage? So right now, like, I guess I'm just was it only assigned to have 56,000 total?
Oh,
Or how
okay.
did you
Yeah,
know
so
that?
it can be a billion shares, it can be
That's
10
right.
shares.
I'm
Here's what I'll
asking.
tell you, if you're in Delaware, I'm sorry.
Yep.
Give me 1 second, it's my boss. 2 minutes. I'm like, oh my God, I know. I'm training someone. He's like, hurry up. I'm like, okay. If you're in Delaware, if you're Delaware C Corp, your taxes, your franchise tax is based on number of shares. So I always make it like a tiny ass number, like 1,000 shares. I have a company who is I have lawyers, they're like, it's like Fulbright and Jaworski. They're big lawyers, and they always send these cap tables and file these things out. And we see them, they'll file like 1 million shares. I'm like, their franchise tax are like $40,000 a year. Are you serious? Like don't do that. Like go in 1 billion shares. No, because you got to pay tax on all that. Not every state, but Delaware. So,
That's an interesting question. So if I'm a Delaware corporation but based in Texas, do I have to pay Texas franchise tax anymore?
so Texas won't have, you have to file for franchise tax in Texas,
so you
yes.
have to be making more than $1 million.
Yeah, you won't pay anything. You still have to file. And they're
Yeah.
due, by the way, don't forget. They're
Oh,
due
I know,
soon.
we did that
Yes.
as an LLC.
Okay. Yeah. Yeah.
Is there like a company that can just like set up your whole seed rounds for you if you don't want to do all the logistics behind it?
To set up all the paperwork and all that stuff. Yeah, there's 1 million of them. They'll all raise their hand. I do, when I have people that need something easy, like you can just use like LegalZoom and people like that, and they're really cheap, and they'll just file your standard stuff for you. You can find a cheap lawyer to do it. You can find stuff online. You can find a buddy who's done it before. You can find a CFO who's friendly. I'm kind of mean, but just joking. Most filings, initial filing stuff, is just a lot of paperwork, but it's not hard. It's just a lot of paperwork. So if you're not familiar, you can go to like legal.com or LegalZoom or something like that, and they'll give you forms for like $50. You know, you can download like a bunch of forms and file. It does cost to file. If you use a firm, like so filing, it costs, expect to cost between $200 and $300, $500 to file your registration papers. In most states, something like Texas is $385 or $345 or something like that.
So would I do Delaware or would I do?
Up to you.
Okay.
Up to you.
Delaware has better.
Well, people go to Delaware because everyone's in Delaware and it's easy and everyone understands the law, and the laws are real consistent and they're corporate favorable. And a venture group's going to know exactly, they're going to give you paperwork that's perfectly made for the Delaware law. But if you're doing an LLC, just do it in the state you're in. And just because it's less filing, it's less paperwork. if you're in Texas, just do a Texas LLC and be done with it. When you're ready to convert, you can convert.
Debt that is raised from angel investors, is it expensive compared to commercial? Or is it,
It depends on how you, so it depends what kind of debt it is. If it's debt that's like convertible notes, it is more expensive, right? Because it's gonna ratchet and it's gonna take more equity and it's gonna expensive long term. But cash, probably less. So most angels, if you're doing something debt with angels, you can usually structure something that's less cash heavy, but it's gonna cost you more in the end on the equity side, right? Or else they put their money in banks, usually. It's a trade-off.
I have one last one tailored to my startup. So we're an S corp right now instead of an LLC based out of Indiana.
Sure.
And we'll convert over to C corp as soon as
Okay.
we get more
Sure.
funding. You didn't sound too excited about S corps earlier.
They're
So
okay.
what
They're
are
fine.
Some things to watch out for.
Just that you can't have you can't have corporations invest in you. So if someone wants to invest and they're trying to give you paperwork with a corp, you can't.
Yeah.
And you only have 100 investors. So that's about it. I mean, there's just,
Okay.
and then when you convert from an S corp to a C corp, there is if you do a straight conversion, there's a tax. It's a very complicated tax thing that has to happen. So make sure you've got a really good CPA doing that actual work,
Okay.
because else you can have a taxable event and an unexpected taxable event. So be really careful when you convert. That's what I would.
Okay.
That's true with an LLC as well, though. Because it's probably still an LLC, but it's a taxed partnership, right?
Exactly.
So it's really about the LLC converting, not so much about the S corp converting. Of course, S corp, you have to do a lot more filings with the state. You have to send all this information saying we're converting and all this stuff. Yeah, it's
I
fine.
got someone covering that for us.
Yeah,
for
perfect.
Sure. Thank you.
All right. Okay, I gotta get on a call. Okay, all right, guys. Yay, go team. Go Mass Town. Okay, compete, guys. I know that was boring. I'm really sorry.
it was not.
Not at all.
It's not at all.